Welcome to our latest Meet the Management podcast. My name is Marc Ashton, and today we are talking SME lending and the Bridgement story. And to help us unpack the story, I'm joined by Dan Goldberg. Dan, thanks very much for joining us this morning.
Thanks, Mark. Really good to be with you this morning.
Maybe to kick this off, a little bit about who is Daniel Goldberg, the entrepreneur.
So personally, I'm Dan Goldberg. I've been running Bridgement for about 10 years, just under a decade. My background is I'm a biomedical and electrical engineer, but I ended up in the world of finance after going into management consulting, working in South Africa and in Nigeria. I lived in Lagos for a while, and ultimately left the consulting world to go into Fintech. I had another startup before Bridgement, and as mentioned, been running Bridgement for almost a decade.
It's amazing you say 10 years. I mean, I know you and I have kind of followed each other's stories along the way, but when I think about 10 years, it's quite an innings already. And I mean, you think about all the innovation that's happening in the fintech space. Maybe give us a sense of what you are trying to solve for with Bridgement.
Bridgement at its core exists to solve one major problem, and that is that too many really good businesses struggle to access the capital that they need, and especially when they need it most. Small businesses, SMEs, are the powerhouses behind our economy. They create jobs, they innovate, they drive ultimately economic growth. And unfortunately, accessing finance has traditionally still been very slow, paperwork heavy, lots of red tape, and it's been designed around sort of historical financial statements, out-of-date financial statements, rather than what's actually happening in a business right now, day to day. So we felt that there had to be a better way, and we created a platform where we use live financial data and AI to better understand a business and how it's performing right now. And that allows us to make better funding decisions and offer funding much quicker and in a much simpler manner to businesses around South Africa in a matter of hours. So since launching, we've funded thousands of SMEs around South Africa across every industry, just about. And we've dispersed just over 2 billion rand, probably closer to 3 billion these days. I haven't actually checked the numbers, but we've had a material impact on the SME ecosystem in South Africa over the last decade.
You've probably got some quite interesting insights. I know we were chatting just before we kicked off this interview about the kind of state of the SME market in South Africa. I mean, anecdotally, what are you seeing out there? Are there sectors of interest, sectors under stress? Where are the opportunities and where are the challenges?
Yeah, so I think an advantage that we have is essentially that we're effectively looking at a live dashboard of the SME economy, basically on a day-to-day basis. In terms of some of the things that we see, so I think first and foremost, SMEs are way more resilient than a lot of people think. I think we hear the headlines, and unfortunately in South Africa, a lot of the time we hear negative headlines. Although I think that that's a common trend around the world. I mean, bad press is good press. But despite all of the negativity around inflation and higher interest rates, a lot of global uncertainty and disruptions in supply chains and logistics. And now the xenophobic riots and protests that have been going on, we've actually seen quite a remarkable resilience amongst SMEs. And we've seen really strong growth in the SME sector over the last few months. I think that aligns roughly with some of the broader business confidence sort of indicators. But from what we see day to day in amongst SMEs is that despite some of these pressures, that they really are thriving. And I think that that's coming out in what we're seeing as a business and the funding that SMEs are applying for. We're seeing a lot of them applying for funding for growth purposes, to fund new hires and new projects, delivery on a major contract, or whatever it is, and much less about surviving a cash flow shortage and plugging a hole. So it's really nice to see more and more funding applications be for growth purposes than for almost survival purposes. We've also seen average loan sizes grow quite dramatically over the last year. I think we've seen our average loan size grow by almost 30%, which is really a good indicator. And yeah, I think ultimately the SME sector is so diverse. It really is not homogeneous. Um, Businesses in different industries look very different and experience macroeconomic pressures in very different ways. So yes, there have been and will be certain industries or sectors that have been harder hit than others. But really, it really does depend on the industry that you're in. I think overall, on average, we've seen really positive sentiment and good growth amongst SMEs.
Maybe just a bit of a segue off that. I mean, you've indicated that your average loan sizes are ticking up. I mean, one of my personal bugbears in South Africa is that we don't have a coherent sense of what an SME actually looks like. When you talk to government, they very much want the one and two man survival type business. I mean, in your head, what is the definition of an SME?
Yeah, it's a good question. And if you look at the strict definitions, it really depends on revenue and essentially headcount. And it's split up or different ranges for different industries. Typically, at Bridgement, when we talk about SMEs and the businesses that we are servicing, we're talking about small and medium-sized businesses doing anywhere from on average about R1 million turnover up to about 50 million annual turnover. That's sort of our sweet spot and where majority of our customers lie. We have some customers that are much bigger than that, doing hundreds of millions. I think we even have a handful of customers that do 1 billion or 2 billion in revenue, but that is quite unusual. The vast majority of the SMEs that we're servicing are in that 1 to 50 million annual turnover bracket. Really depends on the industry they're in and the sort of margin, what type of margin they're operating at. And then headcount, can be anywhere from 1 or 2 people up to 50 or even 100 people. But again, dependent on the nature of the industry and the types of individuals that they're hiring. What we don't currently focus on is sole proprietors and micro businesses under R1 million turnover. That's sort of outside of our target market at the moment.
It's interesting. I mean, you talk about the nature. I mean, when you start speaking about businesses that are doing over R1 billion of turnover and they're using a non-bank lender, I mean, that's quite an interesting development. I mean, I think you'd have always assumed that that would have sat inside of the banking and CIB type environments. But there's always
And
been this
they
perception.
absolutely do. They
Mhm.
absolutely do, by the way. Sorry to interrupt,
No,
but
no, go for it.
they absolutely do. And I think one of the points that's useful to make there is so a few things. So first of all, those sorts of higher revenue businesses that we see tend to be the lower margin type
Mhm.
businesses that might be in a commodity trade or something like that. So it might be super high revenue, but not necessarily as high profitability. Um, and the other important point is in terms of the customers that we're servicing, we sort of segment our customers into different segments, but one of those segments are businesses that are very well banked. A lot of them already are, they might be in CIB, or they're in just the sort of retail business banking sort of segment at the bank. And oftentimes they will have some sort of bank finance. But they're coming to us because either they have hit a limit and the bank's risk appetite doesn't allow them to get more to support their growth, or they need funding in a particular time period for a project that's about to kick off, and they don't have time to wait many weeks to obtain more sort of traditional funding. There are a bunch of other segments that we cater for, businesses that don't have bank funding, maybe because they're too early on in their first 2 or 3 years of trading. They don't have 3 years of financial statements to share with the bank, or maybe they're in an industry that the bank typically doesn't like, or an asset light type consulting business or something like that. So there is a bit of a broad spectrum, but we see lots of businesses that are both well banked and also not so well banked.
And that brings up the subject then about the cost of lending for SMEs. Unfortunately, SME lending in South Africa is, at least anecdotally or on paper, expensive. And particularly at the moment, it is almost like this gap in the market where the banks which could have made it affordable simply don't have the risk appetite, and then the non-banks are having to kind of take into context that risk, and the cost of funding is perceived to be very high. I mean, thoughts around that, and the real cost of lending for an SME in South Africa?
Yeah, so I think there are a few things, and often a few myths as well around this space. But I think the first one is that debt unfortunately inherits a bad reputation from the consumer world. In the consumer world, debt is often abused. It's taken to consume and live beyond one's means a lot of the time.
Mm.
In the business world, debt is used primarily for production. It's completely different. It's used to create or buy productive assets. It's used to generate more revenue, hire more staff, generate more profit, etc., and expand a business. So the whole way debt is framed is very different, and a lot of the time there's a stigma attached to debt from the consumer world, which overflows into the business world. And I think that's one of the first sort of things I always like to highlight. The second thing is that oftentimes the cheapest interest rate, advertised interest rate, is not necessarily always the cheapest funding.
Mm.
Um, and ultimately what we see is business owners, I mean, all people will often focus entirely on what a quoted interest rate is and forget about the raising fee and the monthly ongoing account fees and the other fees that you pay, even if you're not even using the facility, and then the commitment fees, etc. So those fees add up a lot. And if you go and look at any bank's financial statements, you'll see that the non-interest income is a very material portion of their total revenue. I think on one of the big five banks I saw, it was as high as like 50% of
Mm.
their total revenue, which is just indicative of how significant a lot of those fees are. So I think it's always important when you're comparing cost of funding. There's different ways to look at things. And if you're looking at sort of an absolute cost or a percentage-based cost, annualized or not, etc., it's always important to compare apples to apples and consider the total cost and all the fees and everything that goes with it. Um, I think one of the other things that we often see is a lot of business owners actually don't use debt enough. I think a lot of business owners default to thinking, I need to raise equity, especially with everything you see in the news with huge venture capital investments and everything going on in the startup ecosystem. A lot of businesses think, let me raise equity. That's the best way to go. It's cheap, it's free, I don't have to repay it. But unfortunately, equity lasts forever, and it actually is dilutive in terms of your shareholding in your company, and it can be much more costly actually than debt. So I think it's important often for business owners. A lot of people have this huge aversion to debt, and I actually say, well, if you can grow and expand your business with debt without having to dilute your shareholding, and you can do it responsibly, then I think it's a much more powerful tool to use. Provided you have healthy margins and you can earn a return on the capital that you're using that is higher than the cost of the borrowing, then debt really can be the most powerful and amazing tool for a growing business, and help you avoid dilution. So I think, yeah, those are some of the views that we have. I think ultimately SMEs are overlooked and underserved by the traditional sector, and alternative financiers have to step in to service that market and price the risk appropriately. But I think that it's the most amazing tool for growing businesses.
Last question then from my side. I mean, you're obviously passionate about the space. What are the most common mistakes you find with entrepreneurs when they apply for you? What are the reasons they get declined?
Yes, I think first and foremost is having all of your information, financial data in order. Keep good records. These days, cloud accounting packages are so easy to use and so easy to keep up to date with live transactional data feeds, etc. And having that data up to date and easily shareable is so helpful. If you're a bit of a larger business and looking for larger type facilities, then make sure you have your financial statements in place, and readily available to share. I think applying for the right funding is really important. make sure that you understand what exactly your needs are in your business in terms of timelines and repayment structures and all of that. And then off the back of that, work out what is the right product. First of all, if you know, right at the top, you know, there are so many amazing grants out there that a lot of people don't even know about. And some of those grant programs can really be amazing for businesses. And if you're eligible, I think that's one of the best places to start. Then, of course, you have equity, which definitely serves a purpose, especially for earlier stage type businesses, and especially for like R&D type expenditure. And then, of course, you have debt. And within debt, you have so many different types of funding, shorter term and longer term, unsecured versus secured, asset backed, you know, you have invoice finance and different types of factoring and discounting, revolving credit lines versus term loans is really a plethora of products. And it's important to understand what product you should be applying for, what's right for or fit for purpose for your particular needs. And I think lastly, I would say, ensure that you keep personal and business separate. Too often with small businesses, we see that personal and business gets mixed. And when you do that, it makes your data much more messy, and it makes it difficult for a financial institution to really understand your business and the margins that you operate with and how efficiently you operate with and what's real business expenditure versus personal expenditure, etc. So keep those things separate. It will be better for you in the long run when you're applying to a financial institution. And it's also just much cleaner, especially if you have other partners in the business and you're not just a sole director, sole owner of a company. And lastly, just make sure that you are on top of your credit profile, both for the business's credit profile as well as the personal credit profiles of the directors and owners of the company. Ultimately, any credit provider will look at your credit profile, and it's important to keep a clean track record there.
There we go. It's all about track record. Ladies and gentlemen, that's all the time we have for today. Dan, thanks very much for joining us and looking forward to following the Bridgement journey.
Thanks, Mark.
Thanks to our listeners as well. You follow us on meetthemanagement.com. Keep an eye on our social channels and looking forward to our next interviews.